Hi, and thanks for joining me today for another edition of Home Buyer University. Today we're talking about getting pre-approved. So this is where you actually go and talk to a bank and find out what they have to say and how much they want to lend to you. Hopefully you already watched goals, so you already know how much you feel comfortable paying every month. But now we get to hear from the authorities whether they think you can afford. So the first thing I want to do though is clear up some terminology, because we throw these words around and it's not really fair to you because you don't necessarily know what everything means. So the first thing is you hear these terms kind of used interchangeably, like bank, lender, and mortgage broker. And they're not the same. The lender could be a bank, could be a credit union, could be anybody who's going to lend you the money. The bank obviously is the bank, but the mortgage broker is like an insurance broker. So let's say that you're looking for car insurance. You might just call Geico because your friend said they had the best rate, or you might call Liberty Mutual because another friend works there. You could also call an insurance broker. So the insurance agent could look at all the statistics and all the information about your unique situation and recommend one company that you potentially could have gone to on your own, but now you didn't have to do loads and loads of research, and you probably are going to pay the same amount as what you would pay if you went to that company directly. And that's the same thing that happens with a mortgage broker. The mortgage broker is going to look at your unique situation and they're going to say, oh, this lender, this bank, this whatever has a special deal for people in this situation, or you qualify for this type of loan. And they're going to do that kind of paperwork and that running around for you. Not really a bad idea if you don't already have a relationship with a specific bank. And even if you do, you might at least give a mortgage broker a call and see if they can, what they can offer you. So that's basically the difference between a bank and a lender. So every bank is a lender, but not every lender is a bank, and a mortgage broker. The other term that I think I hear people use as if they're the same when they're really not is the pre-qualification versus pre-approval. So pre-qualification just means that you talked to somebody on the phone and they said, oh, not somebody, you spoke to some type of lender on the phone and they took down some information. You gave them verbally the information. So they'll say, well, how much do you make every year? And how much do you spend? And what is your credit card debt? And what's your, monthly payment for your student loans and whatnot? And they add all that stuff up and they just come up with, a calculation that they put, which is basically the same as what you could do yourself online. And they'll give you a letter that says, hey, you're pre-qualified for X amount, just based on what you've told them. But that, I don't want to say it's not worth the paper it's written on, because it's really helpful. It can be really helpful for you to at least give you a ballpark of where you could be. But until you actually get pre-approved, you don't actually know how much a bank is going to lend you, because the pre-approval process, I'm using actually a lot, I'm sorry about that. They're going to request your copies of your bank statements. They're going to request copies of your prior year taxes or your W-2 statements or whatever. They're going to ask a lot more information, and the letter that you get from them is going to be much more specific. Ideally, you'll already know what house you want to buy, or at least be in the ballpark, so that they can factor in things like maybe a condo fee or your taxes or any other monthly expenses that are going to need to come out of that money that they're going to hold for you. For example, my house, they take flood insurance as well as homeowners insurance from me every month. So that all gets factored in as well when they do the pre-approval. So when you present an offer to a seller, at least to the agent, the seller might not know the difference, but at least to the agent, the pre-approval carries a lot more weight. The pre-qualification is really not a big deal. So now I wanted to talk about this idea of you'll hear people say seasoned funds. The funds have to be seasoned. So what does that mean? If I salt my money, that's okay? No, as a matter of fact, seasoned funds means that they've been around for a season, that they've been in your account for a while, so that they don't need to worry about where they came from. Basically, when you get ready to apply for a mortgage, the bank is going to look back. They're going to request 2 months, the 2 previous months' bank statements. And if they see any deposits or withdrawals on those bank statements more than $1,000, they have to ask where that money came from. Now, some of it might be obvious. It might be your paycheck. And then you just say, oh, that's my paycheck, and they'll check that it corresponds with what's on your, pay stub or whatever. But if you receive money from somebody who's trying to help you out because they know you're buying a house or whatever, then that's a little bit more complicated. So let's say, for example, that your parents say, oh, we know you're looking for a house. We just want to give you this $5,000. Okay, super. So you take the $5,000, you put it in the bank, because if it's not in the bank, if it's not in some deposit account, as far as the lender is concerned, it doesn't exist. So it has to be in an account. But when you put it in the account, the bank's going to say, or the lender is going to say, well, where did that come from? And you're going to say, oh, don't worry, my parents gave it to me. Well, if your parents are like my parents and they just pull it out of the safe and hand it to you in cash, then that's going to be a problem, because the bank says, well, where did they get it from? And you say, well, they got it from their safe or under their bed or, in my father's boots. That's not good for a bank. They need to see a paper trail. So they're going to want to see before the money came out of your account, they're going to want to see the exact same amount. Before the money went into your account, they're going to want to see the exact same amount of money coming out of your parents' bank account. And if they can't show that, then you can't use the money. So just be very careful. So the way to avoid this is actually very easy, because as long as the money is already in your bank, is already on deposit before the first statement that you have to give to them. So right now it's February. So if I go to apply for a loan today, they're going to want bank statements from January and December. Okay? So if I deposited that money in November, that's not a problem, because it's already on the December statement. That's the first statement they see, and it's on there already. It's seasoned. Okay? If I deposit the money in January, then we're going to get into all this excitement. December or January, we're going to get into all kinds of trouble. If I don't do it until March, when we're in the middle of the process, don't think that you're going to escape, because they're going to, if your loan isn't closed by April, or if your loan closes in April, then they're going to ask for March. So any months that happen while you're in the loan process. The only way to avoid it is either make sure that you can trace it back to the first day your parents made the money, or that it's already in your account before you apply for your loan. Okay, so now we've got some of the lingo out of the way. Now you need to know, how much do you want to borrow? And like I said, I hope you already did your goals, which was episode 2, and you have an idea of what you feel comfortable paying every month, because that's really what it boils down to. It boils down to how much you can pay each month, not how much you can borrow per se. So, you can borrow $500,000, but now you find out your tax and you say, oh, that's okay, that's only $2,500 a month. I'm totally comfortable with that. But then the place you buy has huge high taxes, and now you're paying an additional $2,000 a month in taxes. Suddenly becomes an issue. So really, you're looking at your monthly outlay, and it's best if you know that ahead of time. So figure out how much you want, and then the bank is going to tell, or the lender is going to tell you how much they think you can pay each month. And as long as it's at least as much as what you think you can pay, then you're fine. Another thing you really want to think about is, how do you look on paper? It's wonderful to be a really nice person, and of course they're going to be happy to work with you if you're a delightful human being. But when I look at you on paper, it looks like you have all kinds of debt, and you aren't making your payments on time, and you just look like kind of a desperado. Am I going to want to give you my money, right? If I'm a lender, am I going to want to give you more money? And if the answer is no, then you have to clean up how you look on paper. So clean up your credit, which we're going to talk about next week. You can clean up your, when you run your credit, is there like you might be surprised to see that there's a bill on there for T-Mobile for $15 because you moved and they didn't ever catch up with you with that bill. Just little piddly things. Or you might find out, like I had somebody else's car loan on my credit report one time. So you just have to get all that stuff cleaned up, and that can take a couple of months. So if you're really dying to buy a house, it can be a drag. So find out ahead of time. So like another way, like if you're a regular W-2 employee, then it probably doesn't matter. But if you're self-employed, it's a little bit harder to get a loan. And not harder like, I don't want to say they're discriminating against us, But I do want to say that banks need to have a good comfort level. They're very conservative, and they want to feel comfortable that the money they're going to give you, that they're going to get it back. And if you are self-employed, they're thinking, oh my God, what if this person gets sick? What if something happens to them? We're going to be loaning them this money and they're not going to be able to pay it back. So instead of just asking for the couple months before's, W-2s or whatever, they're asking for your tax statements, your tax things. Well, of course, if you have any kind of a competent tax accountant, you're not going to show much on your taxes. You're going to have a lot of deductions, and if you have a lot of deductions and you don't show much income, then the bank's going to say, sorry, we can't do that for you. I actually I wanted to cash out one of the properties that I have in New Hampshire, and I said to the guy, so I wanted to borrow $70,000. That was the loan amount, $70,000. And he's like, oh, in order for us to give you a $70,000 loan, you're going to have an annual income of $86,000. I thought, well, that's kind of stupid. But in there, in this particular bank, the way they were calculating everything, they wanted me to have more per year than I was trying to borrow for over 15 years. So, it's just a little bit more complicated if you're self-employed. So think about how you look on paper. I've actually had clients who were self-employed who had shown very minimal income on their last 2 years' taxes, and they actually had to go back and refile those taxes showing more income, because otherwise they were never going to be able to get a loan. So that's a bummer, but you need to be cognizant of the way you're going to look to the lender. Now, the next thing that they're really going to care about is your DTI, your debt to income ratio. And that is just like it sounds. How much do you owe versus how much do you make? And what they're looking at there is your monthly expenses. So if you have a $250,000 student loan, but you're only paying $100 a month, they're going to count the $100 a month. So don't worry about the bigger number, especially with things like student loans, because a lot of banks even have a separate category for those and they don't count them as highly. But that's something to be aware of. So if there's a way that you can get your monthly payments to be lower, maybe you can consolidate some debt, or you can move some debt around so that you're not having as high monthly expenses, then that helps your DTI. There's a guideline that a lot of lenders use, which is 36%, which means that if you make $1,000 a week, $360 of that is all you can use to pay all your debts, including the mortgage that they're going to give to you. So that's a pretty small amount. So just, again, be aware of those things and see how you could possibly move some things around. Some lenders will work with you and they'll say, oh, if you pay off this little loan, then that's going to help you in this way. Some are just going to say, no, sorry, you're rejected. So, but that's a good reason not to give up if you don't like or, want to. If you're not getting a good vibe from the lender, then just chuck them and go work with somebody else, because there is somebody who is dying to give you their money. The other thing is, like I touched on before, is credit. And like I said, next week we're going to talk all about credit, how to look at it, how to clean it up. But one thing that you really should be thinking about is, if you're wanting to get a loan, if you are looking to buy a house, just stop using your credit cards. Stop. Put them in a safe and lock them up, because that changing fluctuation, if you've stopped using them and you're paying them down every month, that just looks and feels a lot better to the credit card companies and to the lender than if you keep going up and down with your credit card bills. So and there is that fine line, right? Well, how much do I save versus how much do I use to pay off debt? I need to have my down payment. So this is a balancing act that you want to speak to your agent and your lender about. So that's basically for the components of your pre-approval. One thing I want to say, again, I touched on this before, but if you are the customer, and the customer is always right. You want to work with someone who respects you, who answers your questions, who's patient with you. If you get a vibe that the person's just always in a rush and they're too busy to talk to you, or if they're not prompt in returning your phone calls and your emails, if they always want to talk on the phone and you really prefer to text, just keep shopping. Find somebody who you like, who you feel confident with, who is answering your questions, and who treats you with respect. If you feel that you've been even remotely discriminated against for any reason whatsoever, I mean, as a woman, I can tell you, oops, I think I hit the microphone there. As a woman, I can tell you that sometimes I feel in certain situations that I'm not being treated respectfully, I'm not being treated fairly. If that happens to you for any reason, there are agencies you can use to report that. There's a link on the blog that will bring you to where you can raise a complaint against these people, because unfortunately, even though this is 2021, it's still happening. There are still bigots out there. There's still people out there who don't want to work with certain types of people, and those people got to go. So don't be shy. Don't just think, oh, it's just me. No, it's not just you. The person's just not doing their job properly, and they need to be educated. So that's it. Tune in next week for Credit Score. And if you missed part 1 or part 2, where we talked about other exciting aspects of home ownership, then definitely be sure to check those out. Have a great week.